That might have been like a foot tap, like tick that I had or something. Sorry.
This is my fidget spinner. I'm doing this the whole time. Like, I like the feel of like doing this with this.
I always play with my broken elastic band.
Oh!
It's touching my hair, but it's not, so it's cool.
This is the Kingscrowd Investment Roundtable. Today, we're going to be talking about a couple great topics in the industry for investing in startups and private companies online. My name's Brian. I'm your host. We're going to be joined by the Kingscrowd team. Both Teddy and Leia are analysts. And we also have our guest, Scott, here to talk about the first topic, which is news. Basically, at the beginning of January, TruCrowd, which has been one of the funding portals that's been around for many years actually in the industry, announced that they were closing. Now, TruCrowd hasn't had a lot of offerings and investment opportunities over the past few years, but we wanted Scott to join us today to tell us, what does this really mean for the industry? So, Scott, welcome.
Nice to see you.
TruCrowd, what's going on there? You know, you were familiar with them in the past, right? Like, what is happening with this?
I will tell you, I am literally going through emails right now. This is a blast from the past for me, for producer Sam, for sure. Some names I haven't seen in forever, but this will give some context. I just think it's interesting. There was a period of time, July, I'm literally reading an email, July 2016, where we were in talks to merge Technori and TruCrowd into one company. Technori eventually gets sold to Kingscrowd, so I was sticking with the crowd no matter what I did. And in that case, effectively, they were allowing, the email literally states, like, such a great call. I totally agree. The whole will be better than the sum of the parts. And what they're talking about is this concept of white labeling the platform. And at this point, they're talking about some small business. They're doing like farm stuff. There's like all kinds of random stuff that they're raising on. And Technori was focused on startups, and we were trying to recruit startups to come and raise through crowdfunding. So they were like, oh, you'll be the portal for this, right? And for producer Sam, there's a name that he'll definitely remember, George Vukotic, who used to be the director of comms at 1871 in Chicago. He goes to TruCrowd, and he's supposed to be the person who's going to bring all the startups. And it just never happened. And I remember, vaguely conversations with Vincent there, and everything was very litigious. I had a lot of respect for those guys, what they were trying to do. I had respect for anyone crazy enough to try to do this stuff in the early days of 15 and 16 and 17, when there was just, you just caught shit. That's all you got for talking about crowdfunding. Brian, you obviously know that well.
Back then it was, 5 deals would launch every week. So you could go and see every single deal. It was manageable. There weren't all of these platforms with all the offerings.
You could text you could find the founder on LinkedIn and like literally hit them up, and like they'd raise like $75K, and you're like, whoa. But I guess to kind of put a bow on the beginning of this, like from the very beginning, if I was going to be just talking bluntly, I always felt like they looked at the space opportunistically and didn't have a plan or a mission or a vision. And you can say about anyone, right? We all pivot. We've talked a couple times about Republic and how they've pivoted towards tokenization more and all this and this. There's nothing wrong with that. But there's definitely something, I think, that WeFunder, Republic now having slightly pivoted, but WeFunder, Republic, Start Engine, now Dealmaker, and we'll get into that maybe later, but like Net Capital, all these guys came into the space with a very clear plan. And they kind of stuck to it for better and worse. Micro Ventures is another example of this. Like they had more ambitious plans, eventually just found who they were and stuck to the niche and are still thriving in that way. TruCrowd was always looking for a way to survive or to make money at this. And it didn't ever feel totally like they had like an idea of where it would end. And I think when you talk to startups, you spend the amount of time I have, and you have obviously, Brian, with startups and investors and VC and whatever, like that doesn't usually end well. That's just like kind of a recipe for disaster, is the like, I don't have a target in mind. And that it's kind of how you end up with your website just being closed, which also, by the way, just last thing is weird to me. I like, probably the thing that threw me off the most was like deciding to move on. I get whatever. It's weird that you're just like, and that's a wrap.
all of these platforms are businesses and startups themselves, and they have to
Right.
find a viable economic model, business model where it makes sense for them. And if you look at TruCrowd, they had a couple offerings last year, if that, and same thing in 2023. So now correct me if I'm wrong, but I think TruCrowd was also the owners of Fundana, which was kind of another spin-off of a funding portal that focused on cannabis offerings. However, they had some legal issues. I know there were some allegations of fraud through the SEC and some other things there. So Fundana
Maybe
shut
that's
down.
why the website's just kind of closed.
Yeah.
I'm not here going to point fingers and say that people are doing things, bad, but I just it's just so funny you mentioned that. And it's just an example of that same sort of fragmented thought process was taking place in 2016 when they just started. I mean, can you imagine you start this thing and within 2 months I reach out to you and I'm like, hey, whatever, and you're like, yeah, we'll fucking pivot the whole it's from the get go. It felt that way. And I remember having conversations when we, I'm looking at emails now with my lawyer, going through all the stuff with that. That's how far it went. I remember having a conversation with producer Sam we were at the time, I think we were at Tech Nexus. We're sitting there literally discussing Republic, WeFunder, Micro Ventures, Wild Bill, shout out to Wild Bill, cap tip, and Start Engine. And we're in Republic, who are the people we should bet on? Where is it going to go? And I remember whiteboard session writing out where I thought that they had advantages. And TruCrowd, I couldn't give you a single one. The only thing I could give you about TruCrowd was that they at that time were offering kind of a white label approach, and now that's kind of a common thing now. Issuance exists because of that. Republic does that kind of thing for tokenization. There's other groups. Yeah, right. So that's actually forward thinking. They probably should have stuck with that. At that time, it's too small a market. They probably would never got here. That would have been the only thing that they did that was interesting. But they just splintered. I don't know. It was weird. It just never felt right.
The other thing I wonder about, right? So we've seen a lot of platform consolidation last year in 2024. Mainvest announced that they were closing, which they were one of the biggest kind of Main Street investing ones. Raise Green's been acquired by Honeycomb. But if you're an investor who invested on one of these platforms and someone shuts down, theoretically, your shares, your investments are supposed to be directly with the issuer, so it should be good, right? But that platform, that intermediary, is kind of the person that puts you in touch. So, what happens to investors after something like that happens if you're investing, in a platform like that?
I mean, I immediately tweeted out Chris Lestrino's phone number on Twitter. If you're a company that needs issuer assistance, come on down. I think it's a great question. I think the biggest issues with crypto is that there's no it's a bag holder scenario. No one really knows what the hell goes on when something gets rugged. And I think that the intermediary platform inadvertently created the same scenario for this private asset class. We're all sitting there I'm getting constantly an insane amount of mail from Pigeon Lee, who's going through bankruptcy, and I invested $100 in that company when he came on the show, and I literally opened my mailbox and twice a week there's another update, long ass letter about it. So when things go bad, really bad, legally bad, it seems to find me. So clearly that worked. Granted, it was through Republic's, they're still alive, but it does feel weirdly the platforms should have to have I almost think you have to have a contingency. If we go under, we have to set aside a certain amount of money to allow some sort of piece of our platform to stay online so that we can handle this. There should be something, or you're sold to somebody who handles this kind of stuff, whatever. That has to be a case, because as this gets bigger, that doesn't sound right.
I want to call out too, because there were so many investors on Mainvest, that I saw a lot of investors asking me about that. And I do know that there were some other funding platforms that stepped up, because especially with Mainvest, you're getting quarterly dividend payments as part of your rev share and debt. And if the platform that was facilitating that is shut down and goes away, how do you get that? They were like, oh, you might get it through Venmo or PayPal, or contact your person and figure it out. It's good luck. But I know that some other funding platforms actually did step up. So kudos to them with helping out there. But I think just another thing investors need to think about.
Yeah, I totally agree. Well, the TruCrowd thing it's unfortunate. You never want to see any of these things go down. We want to see it continue to go bigger and grow and grow. But I do think that whether it's consolidation and you'll see this across all fintech, probably the whole world of businesses in general, but fintech in particular, I think that you're going to see a handful well-known, and at least in our world, well-known groups that are going to kind of fall to the wayside and shut down, because I just don't think that the straight up crowdfunding only is going to be sustainable. And I think they never really got that figured out.
Interesting. Well, thanks for providing that context, Scott. I think we will definitely keep tabs on this moving forward in 2025. Unfortunately, it's just January, probably not the last, but again, we'll kind of see where this evolves. All right, in our next segment, we're going to be talking with Teddy and Leia, and we're going to be going into this week's chart of the week.
The chart of the week this week was an analysis of public versus private revenue multiples. And for the private markets, obviously, we focused on the equity crowdfunding market. So you can see kind of across the board, there is an obvious large gap between private revenue multiples and public revenue multiples. And the obvious reason for this is, startups are generally companies that are expected to show hyper growth in the next 3, 5, 7, 10 years. And so they're able to kind of bake in that future value into the valuation of the company. Whereas public companies, they tend to be far more mature, profitable, and, don't tend to trade at super high revenue multiples. So it's interesting to see that in the equity crowdfunding markets, kind of as you go down and the revenue multiples get smaller for the private industry, those tend to be like the non-tech enabled industries. So like dining, beverage, education, farming and agriculture. Those aren't, the big kind of AI growth software companies or space tech or energy tech, where kind of as you get into those more kind of futuristic industries or companies that are kind of building a big disruptive product, that's when you can kind of see the revenue multiples diverge pretty significantly from the private versus the public markets. But anyway, the largest one we saw was in the energy market. So I wanted to get Leia's take as our climate tech extraordinaire, her take on it, kind of why those revenue multiples are quite high for companies in the energy space.
Well, we know that the energy sector is extremely popular online. There is a hype around it. And to my point, it's relatively justified. The energy sector is one of the sectors that is about to boom, that is already booming, but the demand of our country in electricity is growing exponentially. It's not only because of all the investments in the energy transition, it's also because of the new demand in electricity from AI companies and data centers as well. The electrification of cars, but also ovens and heating is also increasing the demand of energy. So there is a lot of money to be made here. And when we think of public investment, it's actually an industry that is overlooked. So as you can see, the public multiple is very low, 6.38x. And in discussion that I've had with some leaders in the investment market, whether they're from Sequoia Capital or other large fund, I've seen that energy for them can provide way more return to investors than AI, for example, simply because it's overlooked. So the multiples are lower on the public market. Now here, looking at the private market, well, my understanding is that private investors just know about it. And these are the companies that do the best online. Therefore, they can kind of afford to raise with higher multiple because they have these groundbreaking technologies, because these companies are going to be able to see the valuation growing tremendously because they have high revenue potential. When you think about finance, software, AI, these are industries that are a little bit less accessible online. And I believe that's because it's also industries that are favored by VCs, while energy industry is completely overlooked by VCs as well. One of the reasons is that it's a pretty risky industry. When you invest into hardware, deep tech, energy startup, there's a high risk of failure and there's a high demand for capital. So that's why they do well online. Now, I think that as an investor, you have to look at what the numbers are actually at. If you have 100x, but the revenue is only $50,000, it kind of makes sense. Just consider it as a pre-revenue company, invest on the valuation and not on the multiple. Now, if you think that the multiple is outrageous, it may just prevent you from making a return. So it's not because the company is promising that you actually have to invest in it.
No, it makes a lot of sense. And Brian, was there any of these industries that kind of stuck out to you or have a revenue multiple that surprised you or anything like that?
Yeah, I think I had a few quick takeaways in this chart. So Leah touched on a couple big points in terms of the energy industry and what may make that different in terms of private versus public markets. But taking a step back, right? Like revenue multiple, for those of you who don't know what that is even, it's basically the valuation that the company is raising at divided by the annual revenue. So let's say a company was raising at a $10 million valuation. Let's say they had $1 million in sales or revenue. That would be 10x, right? 10 million divided by 1 million equals 10. So when you're looking at a company that has, for example, a 100x, that's a big number. But the reason for that, as one of the points that Leah pointed out, is that it could be that denominator is just very small. Now, another thing that this is kind of taking into account, right, is future growth potential. So this is a revenue multiple you can think of as like a snapshot in time. It's looking at the company where it's at today based on the revenue and what it's selling for. There's a whole bunch of other things that means that's not taking into account. Like, what's their expected growth rate? If that company is going to 10x next year, right, that revenue multiple would be down by a factor of 10. So even though it might look higher here, as a static view, it might actually still be a potentially good investment opportunity if they have the growth, the customers, the traction, everything else to support that. So I think if I'm kind of looking at this chart and just the industry is, one of the things that I'm thinking as well is that we're probably seeing companies that have that bigger upside growth potential for some of the reasons Leah was talking about, right? Electrification of the grid and everything else. But in addition, public market energy companies, they're probably a bit bigger, a bit slower, not growing as much, right? And their upside may be more capped. So it could be a bit of that dichotomy between having really big growth potential for early stage growth companies, whereas later stage growth energy companies rather might not have that same upside potential that, for example, a software company might get in the market or a finance. In terms of some other thoughts here, I think the other thing to realize is that because these crowdfunding markets, the investment crowdfunding is a bit smaller, it can be skewed even whether we're looking at averages or medians here. And so just thinking of some of the energy companies that have been raising recently, they're very capital intensive, right? They need a lot of capital. That means they may be more mature. They may have already raised a lot more capital, which, may kind of mean that they're some of these larger, opportunities that are out there in terms of valuation. Thank you everyone again for joining us. We're going to wrap things up there for this week's investment roundtable. As a reminder, head over to pitchreviews.com where you can get a free newsletter delivered straight to your inbox where you get all these great data-driven insights, charts, and more analysis on deals. In addition, make sure you check out Kingscrowd. We have all of these data-driven insights as well as all the deals, ways to explore it, and track your portfolio. Until next week, we'll see you then. Thanks, everyone.